Hey guys, welcome back to the channel. In our video last weekend, I mentioned that I would be releasing a video soon that would dramatically alter the composition of the dividend portfolio that's shown frequently here on this channel. Well, here it is. This is a video about how I was completely wrong about STOR capital in my last analysis. I'll be discussing all the factors to this company that I overlooked originally, how these have reshaped my outlook on their future opportunity, and at the end of the video, I'll be showing you guys how dramatically this will be changing the portfolio. So make sure you stick around to the end of the video to see that. About 5 months ago, I released a video on screen now where I analyzed STOR capital and concluded that they were not a great investment opportunity and that I would rather invest in other real estate investment trusts. In the months since, the stock has run up 45%, and now that I've fully wrapped my head around the business and their core competencies, I'm kicking myself for not buying into the stock sooner. The methods that I used to evaluate the company were way too surface level, and the initial conclusion that I drew could not be more wrong. Before we jump into the video, make sure you sign up for M1 Finance with the link below to claim your free $10 bonus when you fund your account, and subscribe to the channel for more content like this in the future. This will be a longer video than I usually make, but there's a ton of really good information within, and it will lead to a substantial change in my investment strategy. So make sure you watch the whole video, because if you agree with the points that I lay out in this video, you will probably think STOR capital is a great investment for the future. In this video, we'll be discussing 3 areas within STOR capital's business structure that makes them a great investment. Their market positioning, which allows them to generate higher yields and gives them a huge potential market. Their ability to understand their tenants on a location by location basis, which they then can use to reduce risk, and their superior management team that they have in place, led by their CEO, Christopher Volk. Unlike my largest REIT holding, Realty Income Corp., STOR Capital actively avoids leasing to investment-grade tenants. There are a couple reasons that they do this. One of them is the total market opportunity for non-investment grade tenants is so much larger than investment grade tenants. For some context, STOR Capital currently leases about 2,500 properties to about 500 individual companies, which is a pretty substantial number of companies and stores. However, they estimate that their total potential market, there are about 200,000 companies, which means that STOR Capital only has about 0.25% market share. Obviously, they will not ever end up with the majority of this market. But as a hypothetical, let's say over the next 10 to 15 years, without any growth in the number of companies, they grow their business to a point where they now make up 1% of the market. That's 4 times the size that they're now, which basically gives them no ceiling as long as they continue to perform. On screen now, you can see their investment pipeline, and over the past 8 years, it's tripled in size, which means that they can buy more properties and they can afford to be more picky with their purchases in order to get the best return on investors' money. Another reason that they do not target investment-grade tenants is because there is an inherent premium that investors or companies must pay in order to lease to these companies. Here's Christopher Volk discussing this.
And the second thing is they assume that the credit quality of the tenant drives the desirability of the assets. So show of hands, and I can't see everybody because I got lights here. But if you had a choice and you could own like a Home Depot or an Ashley furniture store, what do you want to own? The Home Depot. Who's raising their hand for Home Depot?
There's a lot of hands up.
Okay, Ashley. Nobody. And then the rest of you might have been the smartest. The guys who didn't raise their hands might have been the smartest because it's sort of a trick question, right? Because to say, do I want to own an Ashley or Home Depot assumes that everything's equivalent, and they're not. So it turns out that if you're going to buy a Home Depot, for example, you can oftentimes pay twice the real estate, the price for the real estate that you could buy the Ashley for. In other words, the Home Depot might cost, $8 million to build, but you're paying $15 million for the asset. And you're paying it because you're buying a sort of a stream from an investment grade company. So first of all, you're paying more for the real estate, which basically means if you ever get it back, if it's ever empty or the lease expires, it's going to be dreadfully difficult to deal with what to do with it.
Investors pay this premium because they believe that their cash flow stream is safer if there is an investment grade tenant in its buildings. However, STOR does not believe this is the case because of their ability to understand their tenants. STOR Capital mitigates the surface level risk of having non-investment grade tenants by having a very diversified portfolio of properties and customers, and by entering into superior contracts. To speak to their diversity, they currently have 2,500 properties, leased to 500 individual companies, who do business in 110 different industries and 49 different states. What this means is that in the event of a lease default, their total cash flow will not be severely impacted by a single tenant. No single company makes up even 3% of their total revenue, and 75% of their income comes from businesses that individually make up less than 1% of their revenue. However, the most crucial aspect of their whole business model is their ability to know their tenant and structure contracts that reduce the risk of non-payment. Here, in the same interview, is Christopher Volk talking about how STOR Capital thinks about this.
Second is Home Depot will virtually never give you property level profit and loss statements. That you just don't know. So you could be owning a store not knowing whether it makes any money or not. And this is very important. Most people think that the credit pays you the rent. It does not. The store pays you the rent. And you know this because whether it's in Canada or in the US, when companies go bankrupt, they jettison all the stores that don't make any money, and they keep the ones that are making money. So for the landlords that actually know whether the stores are making money or not, those landlords have the front seat. They know exactly what's going on. So if you buy the Ashley store, you're going to get the unit level P&L. You're not necessarily going to get it for the Home Depot. You probably won't get it. Also, we tend to do about 80% of our stuff in what's called master leases. So that's where you have, let's say, 10 Ashley stores, but you have one lease that covers all 10 of them. And the reason you like that is because you know that over time, not all 10 of them are going to be profitable. I mean, the store level profitability comes in waves. So if I have 10 of them wrapped up together, if they ever file for bankruptcy, they can't cherry pick me as a landlord on which stores they want. They got to take all 10 of them. But Home Depot won't let you do that. You're going to have, all kinds of Home Depots. So for example, if you had been owning Kmart, hypothetically, in 2000, you would have had an investment grade credit. You would have been feeling very self-confident. And then about 18 months later, they would have filed for bankruptcy. And you would have learned then and there whether your store made money, because they just give you back all the stores that don't make any money. Or they go to landlords and they ask for rent reductions. So credit is a transient thing. I mean, the other thing is that we own these assets for 15 years. I mean, our leases are 15 to 20 years long. So the probability that Home Depot becomes a non-rated credit over 10 years is probably 60%. The probability to become non-rated over 15 years is even less than that, is even more than that. So the credit rating today is not the thing I really need to focus on. So the people that own Home Depots, if you have three sources of payment, the first being the real estate, because if you get the real estate back, then you want to have good. So people buy the Home Depots, they overpay for the real estate. They have no idea of the unit level profitability, which is the principal source of payment, and they're riding solely on the credit, which is transient. And so you need to focus on all three things. And for my money, I'd rather have the Ashley, and on top of that, the risk-adjusted rates of return are so much better. I mean, we're here. What we want to do for you as investors is not necessarily to have like the least amount of vacancies of properties, although we about do at this point. But we don't have that. We just want to make the most money. We want to have the highest rates of return. And I mean, and folks like Warren Buffett understand that, which is why he owns our stock.
Now, this clip was from 2017. And in the years since, the argument that he's making has become stronger. And there's even more data that backs up his claims. If you look at the graph on screen now, you can see how this pandemic has affected STOR Capital and some of its triple net lease competitors who focus on investment grade tenants. What this graph tells me is that there is a small degree of strength in these investment grade tenants, but STOR is able to collect a large majority of its rents despite not having any investment grade tenants. Although we are going to talk specifically about Christopher Volk later in the video, I wanted to summarize part of an article written by him called A Case for STOR, in which he goes into great detail about the massive contractual advantage that they have over REITs who focus on investment grade tenants. On average, investment grade tenants will generate a yield of 5.75%, whereas STOR Capital has been able to generate yields of about 7.9% since 2017. What this means is STOR would have to lose 37% of its rental income before it made the same amount of profit as if they would have if they were leasing to investment grade tenants. For some context, another REIT that Volk was managing during the Great Recession saw a 7.5% loss of rental income. So, in order for average investment grade tenants to outperform the non-investment grade tenants that STOR leases to, there would have to be rental revenue losses over 4 times larger than those experienced in the Great Recession. And if we bring up the charts that we had on screen a second ago, during the very worst period of the COVID-19 pandemic for STOR, they had about 67% of rent payments collected. So, STOR Capital would most likely be able to generate a higher return on investments during a time when many of their tenants were not operating than investment grade tenants were making before the pandemic happened. Here's Volk commenting on why investment grade tenants are not able to generate large yields on investments.
So there's a sea of real estate out there, especially to a handful. Let's say they're in the retail service space. There's maybe 30 investment grade companies, so maybe less than that. So you'll have your Walgreens, your Dollar Generals, your CVS's, your Fresenius dialysis cares. I mean, all this stuff goes off at cap rates at like 5%. 5.5. It's not 3, but it's stupidly low. I mean, you virtually can't leverage it. Your risk-adjusted rates of return are obscenely. I mean, they're non-existent. I mean, and you're paying far more than it costs to build the real estate to do this. And of course, these are people that have no real choices because they don't have a sales force like we do, and they have a tax problem, and they have an abundance of 10,000 real estate brokers that want to solve that problem for them. So.
And with that clip, let's jump into the last key reason why my mind has changed on STOR Capital. And that is the immense amount of trust that I have in Christopher Volk and his decision-making process. Throughout this video, I've shown you clips of Volk, who reminds me a lot of Warren Buffett by the way he talks, his sense of humor, and the way he breaks down very complex theories to a level that someone without specific experience in commercial real estate should be able to understand.
We just want to make the most money. We want to have the highest rates of return, and I mean, and folks like Warren Buffett understand that.
Volk has a long history of starting up and operating successful REITs. In 1994, his first REIT venture, Franchise Finance Corporation of America, or FCCA, went public and was the first net lease REIT to achieve an investment-grade corporate rating. And before it was sold to GE Finance in 2001, it was the nation's largest publicly traded net lease REIT. After that, he started up Spirit Finance, who was later listed on the New York Stock Exchange and eventually bought out by a group of investors. During the time that he owned both of these companies, FCCA generated annual returns of 10.3%, and Spirit generated returns of 19.7%, both of which outperformed the broader REIT market during that time. He regularly writes articles to many commercial real estate publications and is a contributor of Seeking Alpha, all of which are accessible through STOR Capital's website. I just have a huge degree of respect for Volk's intellect, and he tells things how they are, which is nice to see in a CEO. The question for me now is not if I'm going to be investing in STOR capital, but it's really about how much of my portfolio I want to allocate to them. For me, I do appreciate some degree of diversification within a portfolio, because it does protect you from downside risk. But allocating a substantial portion of my holdings to one company has allowed me to capitalize on good investment decisions in the past. So, I have decided that I will be making STOR capital my largest holding in my dividend portfolio by increasing my real estate slice to 30% and by giving STOR capital 60% of the allocation in that slice. Effectively, this should bring my total target allocation to 18% of my portfolio. And in the next couple weeks, I will be directly investing my weekly deposits into this holding to arrive at my new target allocation. Keep in mind that I am making this decision based on my own knowledge of this company and my specific current financial position. So make sure that you do your own research before making any investment decision. With that said, guys, if you enjoyed the video, make sure you hit the like button, subscribe for more content like this, and turn post notifications on so you are notified when I post a new video. And with that said, I will see you guys in the next video.